So let's get back to valuation, right? We've talked about that AR follows net realizable value. So we're going to value it at the original transaction amount to start with, what we would typically just refer to as historical cost. But then we may adjust it for a number of things. One of the big ones, up front, is a discount. So simple question. Why? Why would I want a discount? Why would I want to tell a customer, well, you owe me $100,000, but you can only, you really don't have to pay me $98,000. Well, one reason I might do that is to encourage prompt payment. I look at it as, you know what costs me money and effort and time and this is chasing you. I don't want to do that. I don't want to have to chase down payments that I haven't received. I would much rather spend a little something extra up front, give up some of that revenue, or basically some of that cash collection, so that I don't have to do that. So that's discounting. We refer to this first type as a sales discount or a cash discount, which is given as a percentage off of the sales price. But what's important to know is the way that that discount is typically presented. So let's take a look. The classic example, I do not understand why this is, every textbook I have ever seen shows it this way, uses these specific numbers, and I don't know why, but we're going to go with it. It's what's called here 210 net 30. So 2/10, comma, n/30, but that's how you read it, 210 net 30. What does that translate to? Well, basically is you telling the customer a bit of a story. You're saying, okay, if you pay me within 10 days, I will give you 2% off what you owe me. That's your discount. However, if you don't want to do that, I still expect you to pay me the full net amount within 30 days. But those numbers could change. It could be 315 net 60. It doesn't matter as long as you understand what's important is what is the discount and how do I trigger it. Next big question, how do I account for this discount? And interestingly enough, I have a choice. There's two different ways, referred to as the gross method and the net method. And as we work through our example, you're going to see both of these in action. We're actually going to put them side by side. But first, let's talk about what do they mean. Now, I think of the gross method as ignore up front. Ignore what? Well, I'm going to ignore the fact I even offered the discount. If I'm using the gross method, that usually represents, yeah, I'm offering the discount, but frankly, I don't expect my customers to take advantage of it. I think they're going to use every single day I give them, 30, 45, 60, whatever it may be, maybe even then some more after that, to pay me. But they're not going to be motivated by that discount. In this case, I'm going to ignore it. I'm going to say, okay, we're going to go ahead and record the revenue and the receivable at 100%. Now, the trick is predicting accurately. So the possibility is certainly there that maybe I have a customer that goes, no, actually I am going to pay you early. I would love to take advantage of that discount. Well, that's going to create a problem, and I'm going to need to record that difference because now there's a discount in play and I haven't recorded one. I do that by debiting sales discounts. It's a contra revenue account. It literally reduces the total amount of revenue because originally I recognized 100%, and it turns out for this particular sale, this particular customer, it wasn't 100%. It's only 98. Now the other way I can play this is the net method. So if the gross method is ignore upfront, this one is assume upfront, meaning I'm going to assume my customers are going to take the discount. So I'm not going to record it at 100%. I'm going to record the revenue and the receivable based on the discount included at, say, 98 or 97%. Now, once again, if I predict accurately, that's great. But what if a customer surprises me this time and doesn't pay within the discount period? Once again, I've got a mismatch. I'm short. I have to recognize some additional revenue, a sales discount not taken. And that's going to be a credit. It's going to be a supplemental revenue account. Now, the key thing to note is when the transaction is complete, meaning both the original sale and how that receivable is resolved, I'm going to end up in the exact same place. I'm going to have the correct amount of revenue. Now, it may show up in a couple of different accounts, but it will be the same total revenue, and I'll have the cash I would have had. It's just which one do you think is going to be, well, frankly, a little bit smoother for you to account for. But let me show you what I mean. So let's start our example. And what I'd like to do here is we're going to be going through the journal entries, but I'm going to do it with two columns side by side. On the left, we'll do the gross method. Remember, that's the I'm going to ignore the discount. I'm going to record everything at 100% right out of the gate. On the right-hand side, we'll deal with the net method. That's the I assume the discount. So I'm going to record it at whatever the discount amount is, 98%, 97%, whatever it may be. So here's the scenario. We have Garrity Company, no idea where that name came from, and they have $100,000 worth of goods that they have sold to Olinto. Well, okay, I just assumed it would be Olinto. Apparently it's somebody named Smith. Okay, Smith Company. And here are the discount terms they offered. $210, net 30. Told you it was a classic. Okay, so how do we record the sale? Well, under the gross method, we just disregard. We ignore that discount. We go, well, it's $100,000. That's it. So we're going to debit accounts receivable. That's the amount we're owed. And we're going to credit sales for the full $100,000. Under the net method, however, we're going to assume, oh yeah, the customers are going to take that 2% off. They're not going to miss out on that opportunity. So we're not going to collect $100,000. We're going to collect 98% of that, or $98,000. So in this case, it's still a debit to AR and a credit to sales, but it's only $98,000. And the key is both are acceptable under GAAP. Now, let's see how these would be resolved if the customer pays within the discount period or if they don't. So the name of the game here is, did they guess right? So let's deal with the, yeah, they did. So the first pair of entries we're going to look at are if the payment was received in time to take advantage of the discount, within the discount period, within 10 days. Well, if that's how it plays out, then the net method was the way to go. So the net method's easy. We would debit cash for $98,000 and we would credit accounts receivable for $98,000, and everything matches. What we had as a receivable matches the check we got from the customer. Easy. The other possibility, of course, is they pay us outside of that discount period. If that's what happens, the gross method was the way to go. In this case, this is going to be the entry below it, but this time we're going to look at the gross column for this one. Cash received, it's $100,000. We'll debit cash. That relieves the receivable for $100,000. And once again, everything matches. So as long as what we predict is what actually happens, it's pretty easy. Not much extra heartache or aggravation to go through. But what if we predict wrong? All right, let's go back to the receipt of the money within the discount period. So how does the gross method deal with that? Well, they're going to get a check for $98,000, and that's right, debit cash. The problem is, under the gross method, there's a receivable sitting on the books for $100,000. We got to get rid of that with a credit. So we're missing a $2,000 debit. It's a contra revenue. We're going to call that sales discount taken or something comparable, but what's important is it's going to reduce the total revenue by 2%, which is exactly what should happen. You'll also notice, side by side, once we reach this point, whether we did it using the gross method or the net method, we're going to show the exact same amount of cash, makes sense. AR is going to be zero, makes sense. The only difference is how that revenue shows up. It's going to be $98,000. It's just under the net method, it was 98 right out of the gate. In this one, it's 100 in the revenue account minus 2 in this contra revenue account. All right, one more scenario to deal with. What if they don't pay within the discount period, but we recorded it using the net method? Let's look at that entry. Once again, we get a cash check for $100,000, but we only have receivable on our books for $98 because it was recorded net. So this time we've got a missing $2,000 credit. It's a revenue. We'll call that sales discount not taken. I know, not very creative, but it gets the job done. And that's going to be a supplemental revenue account. Once again, once the payment's received, we're going to show cash of $100,000. That's right. The receivable is going to be gone. That's right. And we're going to show $100,000 in revenue. It's just under the gross method, it's in a single account. Under the net method, it's in two accounts, the regular revenue and this sales discount not taken. For this reason, that's why both methods are acceptable. They both end up in the same place. It's just which one do you think is going to be a little bit easier to deal with. But that's not the only kind of discount we're going to talk about. We also need to talk about trade discounts. So earlier we talked about that the reason we offer a sales or cash discount is to encourage prompt payment. Why else would I want to give whoever's buying this a break? Maybe because they're willing to buy a whole lot. It's a volume discount or a quantity discount. In this case, we're going to quote it as a percentage. Yep, we're going to knock X% off. But here's the thing that makes this a little bit unusual, and probably if you're going to get a question about it, because it's fairly straightforward except for this one point. Discounts are applied one at a time. We'll see what that means in a moment. Finally, there's no need for a gross method here. The reason we have the gross and the net method with a sales discount is there's a question mark. Are they going to pay in the discount period or not? That's not applicable here. They're getting the discount. We know they're getting it up front. There's no doubt about it. So we're going to go ahead and record that using the net method no matter what. So let's see this example. We have Caitlin and Brown, and they're selling some coats. These must be awfully nice coats because they list for $1,000. So Caitlin Brown operates their own small retail shop, we'll say in New York City, and they sell them on the rack for $1,000. But they do also sell it through some department stores. And so they say, oh, if you're a department store, we have a standard discount. If you buy this many coats, we're going to give you 40% off. Maybe Macy's comes along and says, oh, it's not bad, but we're Macy's. Can't you do a little bit better for us? And Caitlin and Brown thinks, yeah, okay, we'll give you 40% and 10%. This is where that one at a time gets involved. Let's do the calculation. Let's say we're starting with 100 coats. So we're talking $100,000. Well, first we say we're giving you 40% off. That's the standard volume discount. So that's going to knock off $40,000. So now we're down to 60. But when we say we're going to give you 10% off that, it's literally 10% off whatever's left. So it's 10% of 60,000. That's only 6 more. So even though you might look at that and go, 40% and 10%, that's 50%. Not for this kind of discount, it's not. It's actually 54,000, which means we gave them 46% off. We give you 40 and then 10% of the net amount remaining. So that's how volume discounts are applied. So now you've gotten the overview of receivables and some of the discounting that they use.